Good morning, student. Today is 2nd June 2020. This is my lecture number 9A. And chapter is accounting principles. In my previous video, I have explained about meaning of accounting principle, nature and characteristics of accounting principles, needs and kind of accounting principles, and I have also explained about going concern concept. It was first going concern concept, second consistency concept, third accrual concept, fourth business entity concept, fifth money measurement concept, sixth accounting period concept, seventh cost concept, so I have explained already in my previous video number 8A, lecture number 8A. I have explained this is lecture number 9A. In lecture number 8A, I have explained all these points one by one. So now, according to lecture number 9A, I have to explain point 8. It will be dual aspect concept. According to this concept, every business transactions is recorded as having a dual aspect. In other words, every transaction affects at least two accounts. If one account is debited, any other account must be credited. The system of recording transactions based on this principle is called as double entry system. Based on system is called double entry system, and we will study about single entry system also, but dual aspect concept is related to double entry system. It is because of this concept that the two sides of the balance sheet are always equal, and the accounting equations will always hold good at any point of time. Assets equal to liabilities plus capital. Whenever a transaction is to recorded, it has to be recorded in two or more accounts to balance the equation. This is also called accounting equation. Total assets of business will always equal to total liability plus capital. If a transaction affects the one side of the equation, it will also affect the other side of the equation, increase or decrease. So this is called dual aspect concept. Point 9. Revenue recognition concept. Revenue recognition concept. Revenue means the amount which is added to the capital as a result of business operations. Revenue is earned by sale of goods or by providing a service. Concept of revenue recognition determines the time or a particular period in which the revenue is realized. Revenue is deemed to be realized when the title or the ownership of the goods has been transferred to the purchaser, and when he has legally become liable to pay the amount. It should be remembered that revenue recognition is not related with the receipt of cash. For example, if a firm gets an order of goods on 1st January 2020, supplies the goods on 20 January only, and received cash on 1st April. Received cash on 1st April. The revenue will be deemed to have been earned on 20th January as the ownership of goods was transferred on that day. So, revenues in case of income such as rent, interest, commission, etc. is recognized on a time basis. For example, rent for the month of March, even if received in April, will be treated as revenue of the financial year ending March only. Similarly, if a commission for April is received in advance in March 2015, it will be treated as revenue of the financial year commencing 1st April 2020. Now next concept, name of next concept is matching concept. Matching concept. The concept is very important for correct determination of net profit. According to this concept, in determining the net profit from business operations, all costs which are applicable to revenue of the period should be charged. All costs which are applicable to revenue of the period should be charged against that revenue accordingly. For matching cost with revenue, first, revenue should be recognized and then cost incurred for generating that revenue should be recognized. Suppose income receivable must be added in revenues and income received in advance must be deducted from revenue. When an item of revenue is included in the net profit and loss account, all expenses incurred on it, whether paid or not, should be shown as expenses in the profit and loss account on the basis of the principle. Outstanding expenses, though not paid in cash, are shown in the profit and loss account. So, all the expenses should be matched in accounting year only. Now, next concept is objectivity. Objectivity concept. This concept required that accounting transactions should be recorded in an objective manner, free from the personal judgment. who prepare the accounts. It is possible only when each transaction is supported by verifiable documents and vouchers such as cash memos, invoice, sales bill, pay-in slip, correspondence agreements, etc. For example, when the goods are purchased for cash, the transaction must be supported by cash receipt for money paid, and if the goods are purchased on credit, the transaction must be supported by a copy of invoice or delivery challan. The cash receipt or invoice become the documentary evidence of the transaction and provide an objective basis for verifying the transaction. So objectivity is one of the reasons for adopting the historical cost as the basis of recording accounting transaction, because cost actually paid for an asset can be verified from the document. Now, next is accounting conventions. Accounting conventions. An accounting conventions may be defined as a custom or generally accepted practice which is adopted either by general agreement or common consent among accountants. Accounting conventions differ from concept in respect to the other matter. So, conventions and concepts both are different from each other. Now, what is the difference between conventions and concept? Let us see. Accounting, now point is accounting concept and accounting conventions. Accounting conventions. So these are two different points. Accounting concept have legal acceptance. It has legal acceptance. Accounting conventions have guidelines based upon custom or usage or general agreement. So we can say it is a guideline for traditional guideline. It is only guideline. Now, next difference may be there is uniform adoption of accounting concept in different enterprises. Uniformity is the most important point under accounting concept, but in case of accounting conventions, there is no uniformity in the adoption of accounting conventions in various enterprises. There is no role of personal judgment. No personal judgment. Judgment follow the accounting concept, but a crucial role of personal judgment involved in accounting conventions and guidelines. So these are the difference between conventions and accounting concept. Now, next point is conventions of full disclosure. Conventions of full disclosure. The conventions required that all significant information relating to the economic affair of the enterprise should be completely disclosed. In other words, there should be a sufficient disclosure of information which is of material interest to the users of financial statement, such as proprietors present and potential creditor, investors, and others. The principle is so important that the Company Act makes ample provisions for the disclosure of essential information in the financial statement of company. The pro forma and content of balance sheet and profit and loss account of a company, various items or facts which do not find place in accounting statement are shown in the balance sheet by way of footnote, such as contingent liability should not be shown in balance sheet, so it will shown in footnote. So next, is next conventions of materiality. Materiality. This convention is exception to and conventions of full disclosure. This concept is exception of full disclosure concept. According to these conventions, items having an insignificant effect or being irrelevant to the user need not be disclosed. These unimportant items are either left out or merged with other items. Otherwise, accounting statement will unnecessarily overburden. American Accounting Association AAA American Accounting Association defines the term materiality as an item should be regarded as material if there is a reason to believe that knowledge of it would influence decision of informed investor. Materiality is an characteristics attaching to a statement, fact, or item whereby its disclosure or the method of giving its expression would be likely to influence the judgment of reasonable person. Now, last conventions is conventions of conservatism. Or prudence. Prudence concept or prudence convention and conservatism convention both are the name of one principle, and this is last principle of the accounting principle. According to these conventions, all anticipated losses should be recorded in the books of accounts. According to these conventions, all the anticipated losses should be recorded in the books of account, but all anticipated or unrealized gains should be ignored. That means anticipated losses must recorded, but anticipated gain or income not recorded. In other words, conservatism is the policy of playing safe. Provision is made for all known liability and losses, even though the amount cannot be determined with certainty. Likewise, when there are different alternatives for recording a transaction, the one having least favorable immediate effect on profit or capital should be adopted. So, effect will result in creation of secret reserve, which is in direct conflict with the conservatism of full disclosure. So, you should remember only one line: anticipated loss should be recorded in the books of account, but all anticipated or unrealized gains should be ignored according to this conservatism or prudence concept. So, this was the last topic of this chapter. I will meet you again in next video with next chapter. For till time, thank you very much.